Welcome back to Share Market Secrets, where we help you navigate the complex world of finance. In this video, we're discussing why job cuts happen when the Fed raises interest rates, and how companies take on debt. So when the Fed raises interest rates, it becomes more expensive for companies to borrow money. This can be especially problematic for companies that have taken on a lot of debt. But how do companies take on debt in the first place? Well, companies can take on debt by issuing bonds or borrowing money from banks. Bonds are essentially loans that companies can take out from investors, and they usually have to pay interest on those loans. Banks can also lend money to companies, and they too charge interest on those loans. When companies take on debt, they usually have to pay interest on that debt. When interest rates go up, it becomes more expensive for companies to pay back that debt. This is why companies that have taken on a lot of debt can be particularly vulnerable when interest rates rise. Corporate bonds can be issued in a variety of ways, including publicly traded bonds, private placements, and bank loans. When a company issues bonds publicly, it must register the offering with the Securities and Exchange Commission and disclose information about its financial performance and operations to investors. This information is used to help investors make informed decisions about whether to invest in the company's bonds. As we discussed, in addition to bonds, companies may also take on debt through bank loans or other forms of financing. When a company borrows money, it typically uses the funds to finance its operations, expand its business, or invest in new projects. But if the company takes on too much debt, it can become difficult to manage and may lead to financial distress. Corporate debt has been on the rise in recent years, as many companies have taken advantage of low interest rates to borrow money for expansion or other purposes. But as interest rates rise, those debts can become more difficult to manage. Now, let's understand the impact of a rise in interest rates on companies. Let's take the example of a company that has taken on a loan of $1 million at a fixed interest rate of 5% per annum. This means that the company has to pay $50,000 in interest every year to service the debt. If the Federal Reserve raises interest rates by 1%, the interest rate on the company's loan would increase to 6%. Now, the company would have to pay $60,000 in interest every year, a 20% increase from the previous year. If the company's revenues don't increase to compensate for this increase in interest expenses, it may have to cut costs in other areas, including jobs. Let's take a look at an example of an Indian company that has struggled with debt. In 2019, Vodafone Idea, one of India's largest telecom companies, announced that it had a debt of over 1.2 lakh crore rupees, $16.5 billion. The company had taken on this debt to finance the acquisition of another telecom company, but it had struggled to generate enough revenue to pay back that debt. When interest rates in India rose, it became even harder for Vodafone Idea to pay back its debt, and the company ultimately had to lay off thousands of employees. Similarly, let's look at a well-known U.S. company that has struggled with debt. Sears, once one of the largest department store chains in the U.S., had taken on a large amount of debt to finance its operations. When interest rates rose, the company struggled to pay back that debt, and eventually filed for bankruptcy in 2018. The company had to lay off thousands of employees and close hundreds of stores. And if you look at another example, in 2019, Jet Airways, a popular airline company, was forced to temporarily halt operations due to financial troubles. The company had taken on high levels of debt to finance its expansion plans, and when the cost of servicing that debt increased, it struggled to stay afloat. One more example of a company that took on large amounts of debt is the Indian telecom operator, Reliance Communications, Arcom. Arcom borrowed heavily to fund its expansion plans, including the launch of a 4G service. However, as competition intensified and revenue growth slowed, Arcom was unable to service its debt obligations. In 2017, the company defaulted on its interest payments, triggering a wave of downgrades by credit rating agencies and leading to a rapid decline in the company's stock price. Despite efforts to restructure its debt, Arcom eventually filed for bankruptcy in 2019, citing a debt burden of over $7 billion. The company's failure to service its debt led to job losses and financial losses for its lenders, employees, and investors. So, as we've seen, companies can take on debt through bonds or loans from banks. When interest rates rise, it becomes more expensive for companies to pay back that debt, which can lead to financial struggles and ultimately job cuts. Let's understand how Fed's decision impacts Indian economy and companies and how it puts pressure on RBI to increase the interest rates. When the Federal Reserve raises interest rates, it can cause investors to shift their money to the US to take advantage of the higher interest rates. This can lead to capital outflows from other countries, including India, and put pressure on their local currencies. As the local currency weakens, it can lead to higher inflation, as imported goods become more expensive. To combat this inflation, the Reserve Bank of India may need to raise interest rates as well, even if it may not have been the optimal decision for its economy at that time. This can then lead to higher borrowing costs for companies and potentially result in job cuts. That's all for today's video. If you have any questions or suggestions for future videos, please leave a comment below. Don't forget to like and subscribe to share market secrets for more insights into the world of finance and investing. Thank you for watching.